Hi, so this is the first of a series of tutorials on the Uniform System of Accounts for restaurants. This first one is going to be the Uniform System of Accounts 8th edition, the profit and loss or income statement. So how to read the 8th edition Uniform System of Accounts profit and loss statement. Okay, so these notes along with a Excel file that holds both of these are posted up onto iLearn, and I will just kind of show you where on iLearn. So if you go to the iLearn site and you scroll down to our topic, which is we are at USARI, Budgeting and Forecasting. These are the lecture notes, so that's the PDF that I'm working off of for this lecture, and the Excel file that has the sample income statements, both of these. Okay, and so that's this file here. Okay, so that's, again, this area of iLearn. Okay, so when you open up your lecture notes, you get this. Now, the Uniform System of Accounts is just a set of standards and rules put out by the National Restaurant Association, making recommendations on how food and beverage operations and restaurants should be reporting their financial statements. Most key of which is the profit and loss statement, or what most people commonly refer to as the income statement. And that's what we're going to be talking about first. So this is, within your lecture notes, just a picture of a sample profit and loss statement, income statement, shown in USAR 8th edition. Okay, so I'm going to open up the Excel version of this, and that's here. The first thing that you want to notice about this format is on the left-hand side you have what the line items are going to be. So sales, cost of goods sold, and the different types of sales, the different types of cost of goods sold, labor costs, the different type of labor costs, a prime cost line, controllable expenses, non-controllable expenses, and then it calculates an operating income and then some overhead stuff, and then ends with income before income taxes. You'll also see this as earnings before income taxes, which people will also refer to as EBIT. Okay, it's the same thing. These two lines mean exactly the same thing. Okay, so what the line item is, and then the dollar amount for that line item. So there were, in this case, $750,000 worth of food sales during the period. Okay, so that's the dollar amount. And then the next column over is a common-sized income statement. Common-sized means that each line item, right, each line item is put into a common size of percentage of total sales. So you'll notice here that this is a percentage of food sales as a percentage of total sales. This number is beverage sales as a percentage of total sales. This is merchandise and other sales as a percentage of total sales. So each of these line items, right, is a percentage of total sales as a percentage of total sales. Okay, so this entire column is the line item, each respective line item, as a percentage of total sales. Okay. The only exception to this, it's a percentage of total sales, is the cost of sales section, where each cost of sales line item here is actually represented as a percentage of its respective sales line. Okay, so notice that this 29% is food, cost of food as a percentage of food sales, right? This beverage cost percentage is beverage cost as a percentage of beverage sales, and this merchandise and other cost of sales is a percentage of merchandise and other sales. So this entire column is the line item as a percentage of total sales, except for the cost of sales section, where individual cost of sales lines are as a percentage of its respective sales lines. Okay, hopefully that makes sense. If not, go ahead and take a look at the at the formulas, and that should make better sense. Okay, so that's how you read each one of these individual columns. Now going down on the rows, the structure is the order of the line items going down on the income statement is fairly similar to all other income statements and regular US GAAP, generally accepted accounting principles. We start off with the sales lines, and we just happen to break out by subsections. Subsections of food, alcoholic beverages, and then any type of other merchandise or other. Depending on what the operation is known for, if there's catering and banquets, you might have a separate catering and banquets line. If it does wholesale commissary sales, like it bulk makes bread and sends it off to some other, some other company, then, maybe it has a separate bread sales line. For Cheesecake Factory, it has like wholesale cheesecake sales, and it'll probably have a line item for separate cheesecake sales and bakery sales. So, and if you've ever been to a Cracker Barrel has like this little retail store attached to its restaurant, and Cracker Barrel will usually show a retail and merchandise sales line also. The reason why you want to split out different types of sales is different types of businesses will have different cost structures associated with them and different growth rates associated with them. So the more different a line item is, or a business section is, the more likely it is that you're going to want to parse it out on its own. Okay, so you'll also notice that I mentioned that beverage is usually alcoholic beverages. In general, non-alcoholic beverages like sodas, juices, milk, coffees are rolled up into the food cost line. So this beverage line is usually reserved for alcoholic beverages like wine, spirits, and beer. Okay, so there you go, merchandise and other. You want to do a subtotal of your breakouts. So if you've broken out by sales, you want a subtotal of total sales. Which cost of sales line you have and you show should be reflective of the sales lines that you've shown above. So if you've broken out a sales line above, you want to make sure that you have the sales lines below. In the Uniform System of Accounts 8th edition, there's a separate labor section. So labor is separated out right underneath cost of sales, and labor is broken out by management, staff, and then the employee benefits of both management and staff. Okay, so this is like the managers. This is generally people who are on salary, so management, and then staff is wage earners. So generally line level employees or people who are getting paid by the hour. So think of this as hourly wage folk, and think of this as people who are drawing a salary. Then employee benefits are just all the benefits that these guys get. So this includes unemployment, it includes insurance, health benefits, FICA, whatever. One metric that you generally want to see is what employee benefits are as a percentage of labor and all kind of base labor amounts. So that as a percentage, equals that divided by sum of that, right? So about 23%, and that's fairly standard. You generally want to see something in the low to mid 20s. In terms of what benefits are as a percentage of what people are getting paid. Okay, and then since you've broken out labor, you want to see a subtotal of total labor. Prime cost, you'll notice, is total cost of sales plus total labor. This is a metric that most of the restaurant industry likes to go by because these presumably are the types of costs that management can take care of on a day-to-day basis and can control on a day-to-day basis. Generally, what you would like to see for a prime cost is something in the low 40% to anywhere in the mid to upper 60-ish type of percent. If you're above 60-ish percent, it's going to be very, very tough for you to maintain your operations in the long run because you're just not making enough after your day-to-day costs to be able to cover your longer term costs, which show up later on in the income statement. So generally the range you want to see for the prime cost side is again in the mid to low 40s to the mid to upper 60% range. So this is right in the middle. Okay, so these are all considered controllable costs. And then some more controllable costs. So by controllable, we mean what can management control? What costs do their decisions impact, like easily, directly impact? So direct operating expenses are usually if you've spent on, say, utensils, you know, like, I don't know, garbage bags, if you bought small wares equipment, so like I don't know, a new sieve or pots and pans, that all kind of goes into direct operating costs. Music and entertainment is pretty standard. If you have a bar, or if you're running a lounge, something with live entertainment, this number goes up considerably. If you're running Chuck E. Cheese, all those animatronic things will also go into here. Marketing, this is all your standard concepts of marketing, like advertising and couponing, but also included in here might be your PR agency, your ad agency, donations that you do for name purposes, so that's all under marketing expenses. Utilities, this includes electric, gas, water, and garbage and recycling. If there's oil hauling, that also goes under utilities. General and administrative, think of this as credit card processing fees, which usually run anywhere from 2 to 3% in and of itself. Aside from credit card fees, if you pay a lawyer, accountant, if you pay insurance, that all gets rolled up into this line item here. So honestly, looking at about 5%, this is probably a little lower than what it should be. This I've seen highs of maybe like 10% or so. Repairs and maintenance, it's as it seems, it's whatever repairs and maintenance are made. This includes both the labor and the parts whenever a repair or maintenance is made. And there you go. Again, since you've broken out other controllable expenses, you want to give a subtotal of this area. Controllable income, you'll notice, is going to be total sales minus prime cost minus total controllable expenses. So, right, there you go. Total sales minus prime cost minus total controllable expenses. So this is a good measure of what management makes based on what it can control on a day-to-day basis, or it can control directly with its decision making, right? Because management can control all of these things with its regular decision making. So presumably this amount of income is a result of everything that management can control, okay? And the reason why we separate out controllable income versus not controllable income is because there are certain expenses that management really just doesn't have control over. Their decisions won't affect certain expenses directly. So for example, non-controllable expenses could be something like occupancy costs. So if the restaurant decides to sign a lease, right, and lease the space that it's in, management can't, just up and renegotiate its lease. So it doesn't have direct control over the occupancy cost, right? It doesn't have direct control over equipment leases. Like the manager could have walked into the operation with all these like leases already in place, like leases for delivery trucks, leases for the ice machine, whatever. It's not something that management can directly control. Same thing with depreciation and amortization, right? The equipment that's already purchased or the building that's already purchased, the HVAC and the leasehold improvements that were already made have to be depreciated, and the depreciation schedule and those long-term purchases might not have necessarily been through any decision making of management. So these are generally considered to be non-controllable expenses, like expenses that management could not necessarily control on a medium or short-term basis. Okay, operating income is controllable income minus the non-controllable expenses, right? So it's what do the operations make? Okay, how much money does the operations make? Then we get into even less controllable expenses like corporate overhead. So, for example, if you run if you are a franchisee, right, you franchised the name McDonald's or you franchised the name IHOP, you have to pay licensing rights back to the mothership. That's corporate overhead. Interest expense, if your company like has debts and has to pay interest on the money that you borrow, that's here also, and any other random income or expense that's not a part of regular operations, right? And then your income before income taxes is just your operating income minus all of these other weird non-regular operating expenses, okay? And that's how you would read the Uniform System of Accounts for the Restaurant Industry, the 8th edition.